and welcome to another edition of the Market Review, where we bring you developments in the financial and capital market as it relates to the economy. Today, Tuesday, December 22nd, 2020, we discuss developments around the fixed income and bonds markets. Our topic of discourse is towards a robust Nigerian FX market regime. We'll take the outline from the PFI Capital Analysis on Nigeria's FX markets, ZCREST perspective on FX market in Nigeria, and ProShares research analysis on Nigeria's current FX market activity. And we'll ramp it up with the assessment of assets managed under the environment, social, and governance considerations. According to PFI Capital, Nigerian Naira lost close to 30% in value within the last 1 year and more than 200% in the last 10 years. The situation has led to a spike in capital outflow, high unemployment, the alarming rate of inflation, and other direct and indirect consequences associated with the exchange rate crisis. While greater attention has been placed on the COVID-19 as the root cause of the diverse economic challenges this year, the current FX situation should be looked at from different perspectives. Primarily, the existing structural and policy challenges that have been limiting the country's foreign exchange earnings over the years and the COVID-19 induced shock on global energy demand. The COVID-19 effects earlier this year showed that because of restrictions imposed by countries when the COVID-19 was declared a global pandemic by March, the fall in global energy demand put pressure on the oil price, which witnessed Brent going down by about 57%, closing below $20 per barrel. Nigeria, an oil-dependent country with over 81% export earnings from oil, had earlier benchmarked the oil price at $60 per barrel in the 2020 budget, with daily production estimated at 2.80 million barrels per day. The oil crisis forced a review of the oil benchmark to $28 per barrel. Consequently, the Nigerian government oil exports between January and May contracted by about 77%, and this put pressure on the FX reserve and led to the first devaluation of the year, despite the $3.4 billion loan from the IMF. The official rate was reviewed from 206 naira to a dollar to 260 naira to a dollar, while sales to BDCs was pegged at 279 naira to a dollar, and then followed by suspension of FX sales to the BDC with limited intervention across different FX windows. The big question from PFI Capital is COVID-19 the main factor behind the current FX crisis? While this cannot be neglected, the adverse impact of COVID-19, a look at the country's trade accounts last year showed that the country started a trade deficit run from fourth quarter 2019, despite the moderately buoyant oil price in the year. From a 2.4 trillion naira trade surplus as of the third quarter of 2019, the country recorded a trade deficit of about 500 billion naira in fourth quarter. Similarly, from the latest third quarter trade data released by the National Bureau of Statistics recently, the country recorded a 4.6 trillion naira trade deficit within the first 9 months of this year. Even with the COVID-19 restrictions on international trade, the country still recorded a 19% growth in imports, despite a 37% and 38% decrease in crude oil and non-oil exports, respectively. This tells of the overarching consequences of structural inadequacy that has been limiting domestic production and thereby leading to trade deficit with unnecessary pressure on the currency. Despite the various interventions into the agricultural sector via the Central Bank of Nigeria Anchors Borrowers Program and other development finance initiatives, the import of agricultural goods still increased by a whopping 109% compared to second quarter 2020, with agricultural exports dropping by 21% in third quarter 2020. Now let's go to the backlog of FX demand putting pressure on reserves, still from PFI Capital. From the review of the foreign reserve as of May 2019, it was comfortably around $45 billion due to fairly stable oil price in the year. However, according to PFI Capital, we have seen a continuous decline as the Central Bank of Nigeria kept on defending the Naira at all costs. It is an indication that this issue actually started even before COVID-19. Notably, the foreign exchange reserves had been depleted before 40 billion naira before the end of the month. In short, the first, second, and third devaluation are long overdue, with added pressure from COVID-19. Following the suspension of foreign exchange to BDCs and other FX operators in March, the backlog of FX demand from both manufacturers and foreign investors was estimated at $7 billion in June 2020. The $2 billion was attributed to the manufacturers and $5 billion estimated for foreign equities investors and investors in the automobile, which were querying to repatriate their funds. As restrictions were lifted and economic activities improved in the third quarter, demand pressure aggravated amid declining reserve and low prospects in oil prices. As the major source of foreign exchange inflow in the country, the investors and exporters window and interbank segments, the central bank had no option than to devalue the currency again. Basically, COVID-19's impact on the oil price, slow recovery from the 2016 recession, and structural issues limiting diversified export earnings triggered the various devaluations we have witnessed this year, including the recent one. Let's look at the component of 2016 crisis and consequent recession. One striking similarity between the current FX situation and that of 2016 is the fact that both are linked to oil prices crisis. This clearly shows that the diversification policy action of the government has not yielded the sufficient result to insulate the economy against oil price shocks. The oil price crisis, which started from mid-2014, severely affected the Nigerian economy via lower export earnings. The oil production shortage significantly aggravated the decline in oil price that led to a contraction of the oil and non-oil sector. The drop in oil price and decline in volume due to militant operations depleted the foreign exchange reserve significantly. The government has failed to devalue the naira, and investors struggle to get forex. Due to the uncertainty, foreign investors got frustrated over the shortage of foreign exchange and impeding problems from the recession. Though the economy exited recession in second quarter 2017 with marginal gross domestic product growth of 0.5%, the growth trajectory has been flat and the economy has not been showing that significant sign of returning to the pre-2016 gross domestic product growth of about 6%. One major difference between the two crises is the absence of investors and exporters window in 2016. The I&E window was introduced after the 2016 FX crisis. The introduction of the I&E window in April 2017 improved price discovery in an interbank market, resulting in increased market participation and foreign exchange liquidity, with Central Bank of Nigeria as a key player. Now, what has been happening to capital importation in Nigeria? One major problem discouraging foreign inflow into the economy is the high-risk business environment due to the security challenges and deplorable level of critical infrastructure. Due to the level of insecurity across the country, where businesses, owners, and farmers are not safe to go about their businesses, foreign direct investment has been discouraged from the economy. Recent data on capital importation by the National Bureau of Statistics showed that capital importation decreased by 74% year-on-year in the third quarter of 2020 compared to third quarter 2019. Notably, an 86% fall in the FPI, foreign portfolio investors, was recorded in second quarter 2020 compared to the experience of third quarter 2019, and 42% decline compared to third quarter 2015 before the 2016 crisis. As at early 2019, about 80% of the FPI were channeled into the money market instrument. A significant contraction in yield as a result of Central Bank of Nigeria restrictions on OMO bills led to reduced FPI inflows into the country. One other turn-off to capital inflow is the ambiguity about the Central Bank of Nigeria's stance on devaluation. A flashback to 2019 shows that the Central Bank of Nigeria at an investor meeting in London stated clearly not to devalue the naira until foreign reserve falls below $30 billion. The pronouncement itself led to speculative demand for foreign exchange immediately. The reserve fell below $40 billion at the end of last year. Then on to CBN new policy on remittance. Is the problem half solved? Well, the new CBN policy on disbursement of foreign exchange remittance through the international mobile transfer platforms is a welcome development to bridge the gap between the parallel markets and the official rate. It will send a message of transparency to Nigerians in diaspora on how to get a fair value for their foreign exchange and consequently encourage more remittance inflow into the country, with the Central Bank of Nigeria targeting about $2 billion remittance monthly. PFI witnessed a positive reaction to the circular as the Naira gained more than 30 Naira in the parallel markets. From the record of 510 Naira to $1, it earlier closed. Nevertheless, the proportion of remittance in terms of foreign exchange need is small to offer a sustainable buffer for exchange rate stability. Central Bank of Nigeria has disbursed over $1 billion to the BDC since the resumption of the FX supply in September, and the gap between the official and the parallel markets is still widened. This prompts some concern from the Central Bank of Nigeria, leading to measures to liberalize the supply side to close the gap. Then comes the OPEC cautious ease on output quota, a relief in the midst of concerns. To some extent, decisions from the OPEC meeting on 4 December 2020 raised hope for oil-producing countries such as Nigeria and Algeria. In the reaction to that meeting conclusion, Brent hit the highest level since early March as OPEC members agreed for a cautious 500,000 barrels per day increase in supply starting from January. This alleviated concerns as some members earlier demanded a 2 million barrels per day quota increase. Hopefully, the cautious increase will keep the Brent price comfortably above the $40 oil benchmark in the Nigerian 2021 budget if the 1.86 million barrels per day production target can be achieved. One gray area PFI Capital notes is the quick recovery of the global energy demand by January, bearing in mind the new wave of COVID-19 which is sweeping across the globe. Similarly, despite the United Kingdom approval of Pfizer vaccine and FDA approval of Moderna's effective distribution of vaccines, how this is done across economies will be very critical and may materialize by second quarter of 2021. For the World Bank and the IMF position on the exchange rate unification and flexibility, before granting the recently approved $1.5 billion, the World Bank maintained that the present administration needed to change foreign exchange policies if it wanted to get the loan. According to the World Bank, merging the different exchange rates and allowing the Naira to float more freely would speed up the recovery of the economy. Central Bank of Nigeria Governor and Finance Minister have also said they will seek a more flexible and unified Naira as part of the pledge made to the IMF for the release of $3 to $4 billion in emergency financing in May. The IMF also maintains that a unified and flexible exchange rate will ease external imbalances, while a more flexible exchange rate would offer us the better of automatic adjustment in the balance of payments, absorption of sudden shocks like COVID-19 impacts, and independent monetary policies, which comes with its own problems of high risk, uncertainty, and inflationary character. This may impose further hardships on businesses and investments. Additionally, one major implication of the unification is that the Naira may be depreciated further to meet up with supply and demand equilibrium. This tends to increase the prices of imported goods and services in the country. And also, what's the hope for the Naira during this period of uncertainty? With the external reserves still on a continuous decline, PFI Capital says there's need for significant export earnings to reduce pressure on FX demand. A first choice scenario is if oil prices can maintain the current trajectory hovering around $50 per barrel, and the country can achieve the 1.86 million barrels per day production target. The pressure on the foreign reserve should reduce even as the backlog of FX demand is cleared. The onus, however, rests on the cooperation of major oil exporters under OPEC and not to violate the present quota. Similarly, the effective implementation of the African Continental Free Trade Agreement, which is set to kickstart by January, will also open up the economy to other African countries. The opening of the land borders should boost the export earnings of domestic manufacturers, especially those in the consumer goods space. Some of them have lost significant revenue since the border was closed last year. So let's take a look at what is the way forward from PFI Capital. It wants the Central Bank of Nigeria, currently faced with a trilemma policy option of maintaining a fixed exchange rate, attracting capital inflow, and having an independent interest in the decision, to look at a broader economic sense and also address the macro issues of negative GDP growth and nearly 30% unemployment rates, high inflation rates, and lastly, exchange rate challenges. For PFI, while policies to tackle these challenges are not necessarily conflicting, there is some certain level of mutual exclusively forcing a trade-off. The trade-off brings a fast solution from these challenges and will depend on the policy response of the government on how to tackle the major challenge of insecurity and infrastructure deficiency that has taken investment away from Nigeria's economy to the so-called small economy in Africa. Let's take a look at ZCRES's analysis on the FX market. ZCRES says that the rates remain relatively stable in the FX market as supply-led remained low for most of the trading session, causing no change in closing rates at the official trading segments, and consequently, other market segments remain unchanged, with the cash and transfer market closing at 475 naira to a dollar and 490 naira to a dollar respectively. For ProShare Research reviewing last week's foreign exchange market, it said week-on-week performance of the naira at the investors and exporters window showed that the naira appreciated against the US dollar by plus 0.25% at the BDC market, while it also appreciated by plus 1.04%. The naira closed last week at 294 naira to a dollar at the I and EFX window, and the NAFEX spot market closed at 290 naira, 85 kobo to a dollar. At the BDC market, it closed at 475 naira to a dollar, or in terms of the British pounds, 630 naira to pounds, and of course, that was the development around the currency markets. ProShare Research expects the Central Bank of Nigeria to continue its FX management strategy in supporting the naira at the parallel and investors and exporters window. And just to let you know that assets managed with environment, social, and governance considerations continue to surge across the globe. And while still likely driven by institutional investors, the retail side is growing dramatically. In fact, money managers who use the environment, social, and governance factors in their investment analysis say climate change continues to be their top concern and the leading criteria as they put money to work. Between 2018 and 2020, total US domiciled sustainably invested assets under management, both institutional and retail, grew 42% to $17.1 trillion, up from $12 trillion according to the Forum for Sustainable and Responsible Investments 2020 report. The latter number represents 33% of the $51.4 trillion in total US assets now under professional management across the globe. And that'll be all for today's edition of the Market Review. You can join the conversation on the developments in the Nigerian FX market. Send your views and comments on what you think on how we can have a robust Nigerian foreign exchange markets to news@prochange.com and also tag us on WebTVNG. For on our website, www.prochange.com, you can read more about what's happening in the bonds and fixed income market, even there see what's happening in the foreign exchange markets. Just be part of this conversation continually and engage us, because Market Review is all about financial and capital market and how it relates with the economy. Till we come your way again, thank you for watching. Have a nice day and stay safe.